Not a bad place to do a video. I'm up in the mountains again. Hope everyone's having a good day. Beautiful day out here in Colorado. I was thinking the other day as I was driving out here, one of the things I've learned the last year and a half, 2 years as I've been studying macro is how banks work. That's pivotal to understand macroeconomics. So banks run, the only limiting factor on them handing out a loan is the risk of the borrower. That's why credit scores exist. Because if all of a sudden borrowers took out this money and they can't pay it back, the bank goes insolvent and therefore can't pay their depositors back. So that's a big issue. So banks are in the risk mitigation when they hand out loans. They have to get a better rate of return, a better interest rate on people who have worse credit. And as I told you guys in the video the other day, how stupid Washington is being with the new home loan program when they're giving better interest rates to people with worse credit, and then they're funding that through people with good credit. Obviously, that will have many unintended consequences. But the same thing happened in the car industry. And at the end of the day, obviously, the car industry is not nearly as big as the housing industry. But if banks don't get paid back for these car loans at scale, people are underwater at scale to a scale that we've never seen before, the bank's going to have some real solvency issues if they're an auto loan lender. And guess what? The pristine economy that Washington talks about all the time, obviously you guys know it's not pristine. The auto loan industry is one of the ones that has the worst numbers. You guys know what happened in 2021, 2022. I've told the story of how I sold my vehicle to the same dealership I bought it from. I sold it used for $7,000 more than I bought it for. That kind of math doesn't make sense and has never existed in America, and it has consequences. And now those consequences, those chickens are coming home to roost. So let's take a look at this article here from Automotive Blog. And it talks about negative equity. Automo blog. Okay. So the negative equity that people are carrying in their vehicles, meaning they owe more than it's worth. And what do you think people are going to not pay on first? Their house or their car? Their car, right? And then their credit takes a dump because they're not paying on their car. And not to worry, Washington's here to save you. You can take out a loan from the Fed because no bank, remember I talked about banks being risk mitigators. No bank is going to give you a good rate or a good interest rate if you have bad credit because they can't take that risk. You know who can take that risk? Infinite money printer. George Gammon talked about this the other day. The liability of the Federal Reserve, if the Federal Reserve is your bank, it becomes the infinite money printer because they don't have to worry about solvency because they can print. That's very important. You cannot have these crazy financial rules that don't make any sense and the math doesn't make sense, like the home loan thing, without having an infinite money printer on the back end. Because no economic actor, smart economic actor, is going to take that risk of giving out loans at lower interest rates. We've tried this before. Okay, so reading for the story, early signs of negative equity surge in the auto loan sector and have begun to emerge in the first quarter of 2023. Not a surprise there. According to the data from Edmunds, the average negative value of auto trade-ins was $5,341 in Q4 of 2022, up 29%. So the rate of change is what matters, folks. It's not because you all know if you buy a brand new car, you lose value as soon as you take it off the lot. But it's the rate of change that we're worried about here. The number of vehicle sales that involved trade-ins with negative equity has jumped 17% over that same period. These trends are two of the several that are spurring concerns with the automotive and finance industry. A sudden dramatic increase in negative equity could put countless borrowers in dire financial circumstances, which that has systemic risks in the economy because one man's loan, or one man's payment, is another man's income, and have ripple effects throughout the financial industry, aka if you don't pay your loan, like people weren't paying their loan in 08 when it came to housing, 07, 06, and interest rates went up on houses, these banks went insolvent. Same thing can happen for auto loan banks. Why are people suddenly underwater on their auto loans? It hasn't been just one thing that put American borrowers in this situation. A perfect storm. There's a lot of perfect storms in our economy. You notice that? You hear the phrase, oh, it's a perfect storm. We couldn't even see it coming. It all has to do with central planners jacking with interest rates and financial engineering with millions and billions of people. It doesn't work. That's your clue. It doesn't work. But they cause these perfect storms all the time. So the supply chain issues, which I think were overstated, and then all of a sudden used car prices went through the roof and then they came down, and now higher interest rates. The inflated price of used cars added enough expense on its own, but car buyers are also hit with a dramatic increase in annual percent or APR at the same time, as the Federal Reserve attempts to tackle inflation in 2022. And some borrowers have these loans that they take out that aren't fixed on cars, just so you know, especially people with bad credit, in order because they incentivize them with a lower interest rate up front. It ordered a series of increases, Federal Reserve funds. You guys already know that. And now we have the rising cost of living. So what are you going to pay first? If you're a rational actor in the economy and you have heating bills, you have food going up, your pay or your income isn't going up, and you took all these loans based off of no inflation, and now you have 10 to 20% inflation, what do you choose to pay? Your underwater vehicle? No. People aren't going to pay that. In some circumstances, borrowers have been able to weather the storm by paying more towards the principal of their auto loan. However, a roughly 6.5% rate of inflation during 2022, obviously that's understated, multiply that times 2. They also had to spend more on utilities, food, and other life expenses. We already know this. And Americans are not the type of, we don't have the culture that people have a rainy day fund. Majority of Americans can't afford a $1,000 emergency fund. So you got to ask yourself, which I have, are people making it by? Credit cards. And then eventually that dries up. And then they have $100,000 in debt from their card and their credit card and just consumer debt. And they make $50,000 a year. You see the problem. And this is chickens coming home to roost. Recent reports from Cox Automotive have suggested that without the ability to meet their expenses, let alone find extra room in their budget to pay towards their car loan. Again, people will choose to not pay their car loan. Auto loan delinquency rates, remember, rate of change. Auto loan delinquency rates have climbed to their highest level in over 15 years. So 2006 is when we saw this before. What happened after 2006? Why weren't people paying on their auto loan? Because their home interest rate was going up. So what did they choose not to pay? Their auto loan. So if you have a fixed rate loan today, your home payment isn't necessarily going up, but other things are: utilities, food, etc. So now we have inflation. So it's kind of the same effect. Auto loans are considered to be severely delinquent when they're past 60 days or more. The data from Cox Automotive shows that 1.89% of all auto loans are severely delinquent in January 2023, the highest rate since 2006. I've talked about shoes that drop, the next shoe to drop. Auto loans are one of those things that I'm like, this is another canary in the coal mine. If you watch what happened in 2006, people stopped paying on their auto loans because their housing payment went up, and then they stopped paying on their house, which affects people's credit. And now you see Washington coming out basically saying that credit scores don't matter. They can't actually say that to banks because banks use that as a liability, as a risk measure. So if you just go to a bank and you say, hey, don't worry, just give out loans, doesn't matter the credit score. You don't have to do higher interest rate for bad credit scores. Banks can't stay solvent and do that. So how do they financially rig the economy to have people who have low interest or low credit scores get a better interest rate? How do you do that? You only do that with an infinite money printer. And guess what? All this leads to, you guessed it, inflation, because it's more money chasing after goods and services, more money in the system with not a lot of risk because there's an infinite money printer. So if these people default on the loan, don't worry. Uncle Sam's got you. Uncle Sam is you and me paying taxes. All right, guys, let me know what you think in the comments below. I'll be out here for the next couple days. So a couple more videos from the mountains. Let me know if you guys want to see some footage. I got some cool drone footage yesterday. But I will see you all in the next one. Peace.